For decades, mortgage approvals relied on a legacy framework called Classic FICO. It functioned as a static snapshot, producing a single three-digit number summarizing your entire credit history. This old system only measured what your balances looked like on the specific day the bank pulled your credit report. It had no way of knowing if those balances were a permanent fixture or one-week anomaly. That legacy system is currently being dismantled. The Federal Housing Finance Agency has transitioned the market to two predictive models, FICO 10T and VantageScore 4.0. Your financial profile evolved from a still photograph into a 24-month high-definition video of your behavior. Because the algorithm tracks your momentum over 2 full years, you can no longer successfully clean up your finances at the last minute right before submitting an application. Winning the mortgage long game in 2027 requires surviving a relentless, multi-layered algorithmic audit that evaluates your complete historical momentum. The widest layer of the automated funnel is defined by trended data, the T in FICO 10T. To see how this sorts borrowers, consider Alex and Jordan. Both hold a 700 credit score, and both owe exactly $5,000 on their credit cards today. The algorithm sees that Alex's balance crept up from $2,000 to $5,000 over 2 years because they only paid the minimums. The machine flags this trajectory as a revolver, a high-risk indicator of financial stress. Jordan started with a $15,000 debt, but has been aggressively paying it down for 24 months. The machine rewards this positive momentum, labeling Jordan a transactor and offering a lower interest rate. These models also validate alternative data. For the first time, the machine rewards 2 years of consistent, on-time rent and utility payments, using those habits to build a more accurate risk profile. Even when present-day debt numbers are perfectly identical, the machine uses your historical momentum to determine if you are a safe bet. Below the credit history, the funnel tightens. The algorithm moves past the bureaus to scan the actual cash flow in your bank accounts over the last 90 days. Digital scrapers like Plaid scan every single deposit and withdrawal, looking for microscopic red flags in a process known as purging the leaven. Because the algorithm demands every asset be verified and sourced, a simple $40 Venmo transfer can trigger a manual audit. You may be forced to provide a signed gift letter and even your friends' personal bank statements to prove they aren't fronting you an undisclosed loan. The system also flags automated buy now, pay later deductions to services like Affirm or Klarna. The predictive model interprets frequent microloans as a sign of cash flow strain and an inability to manage liquid buffers. To pass this layer, your down payment funds must be quarantined in a scrubbed account that reflects only boring, verifiable payroll deposits. The final pinch point is the debt-to-income ratio, or DTI. This is the rigid mathematical gate that determines your ultimate borrowing limit. Automated systems like Desktop Underwriter enforce a hard ceiling on your back-end DTI at 50%. If the math hits 50.01%, the computer simply shuts the gate, with no human supervisor to appeal to. This math is based strictly on your minimum monthly payment obligations. A massive student loan with an income-driven payment of $50 impacts your borrowing power far less than a small credit card with a $100 minimum payment. If you are hovering near the 50% cliff, clearing small, high-interest credit card balances does more to lower your DTI than chipping away at a massive student loan. Lenders treat installment loans with 10 or fewer months remaining as temporary burdens that don't affect your long-term borrowing capacity. By prepaying an installment loan, like a car payment, until exactly 10 months remain, the automated system will entirely drop that liability from your DTI calculation. Understanding these raw mathematical rules allows you to adjust your liabilities and survive the final automated rejection gate. The moment your application enters the automated underwriting system, your financial life becomes entirely frozen. You enter a period governed by the 10 commandments of underwriting, a set of rigid rules designed to protect the profile the machine has already approved. During this window, you cannot change career paths, finance a new vehicle, or move large sums of money between your own accounts. The algorithm has approved a hyper-precise snapshot of your life. Altering a single data pixel shatters that logic and can instantly kill the deal. The 2027 lending system is engineered to reward verified, long-term stability over short-term account manipulation. Predictive models now analyze 24 months of microscopic daily transactions just to approve a mortgage. If algorithms already use our daily microtransactions to determine where we live, how long until they determine where we work, what we pay for insurance, or how we access healthcare?